Before we get started, it's critical to understand that I am not a licensed financial advisor, mortgage broker, or real estate professional. This presentation is for informational and educational purposes only. It is not, and should not be considered financial, legal, or investment advice. The home loan strategies discussed in this video involve financial risk and may not be suitable for your specific situation. The real estate and lending markets are complex and constantly changing. Always consult with a qualified and licensed professional who can analyze your personal financial circumstances before making any decisions about a home loan. You've done everything right. You've worked hard, you've saved diligently, you've sacrificed nights out and vacations. You've built up a nest egg, maybe 5, 10, even 15% for a down payment on a home. You find the perfect place. It's got the right number of bedrooms, a yard for the dog. It's in a good school district. You feel that surge of excitement. This is it. This is the moment you've been working for. You go to a lender, you get pre-approved, and then they hit you with the acronym that crushes so many American dreams: PMI. Private mortgage insurance. Suddenly, your estimated monthly payment jumps by $200, $300, even $400. And the lender explains that this extra fee, this PMI, isn't for you. It doesn't protect you if you lose your job. It doesn't pay your mortgage if you get sick. It's insurance that you pay for to protect the lender in case you default. Feels like a penalty. A penalty for not having a massive 20% down payment just sitting in the bank. It's the single most frustrating part of the home buying journey for millions of people. A financial parasite that leeches money from your wallet every single month without building you a single dollar of equity. But what if I told you that for many buyers, PMI is completely optional? What if I told you the 20% down payment rule is one of the most pervasive and outdated myths in modern real estate? What if there was a well-established lender-approved strategy to put down just 10% and legally, ethically, and completely eliminate PMI from day one? That's exactly what we're going to break down today. This isn't some fly-by-night trick or a risky loophole. This is a powerful loan structure known as the October 10th, 80 mortgage, or a piggyback loan. And understanding how it works could be the difference between you buying a home this year or sitting on the sidelines for another 5, saving up for a 20% down payment that you might not even need. This strategy has the potential to save you thousands or even tens of thousands of dollars and get you into a home faster than you ever thought possible. So, to really grasp why the 80/10/10 is such a game changer, we first have to understand the enemy: private mortgage insurance. Why does it even exist? It all comes down to risk and a magic number for lenders: 80%. Lenders have determined through decades of data that borrowers who have at least 20% equity in their home, meaning their loan is 80% or less of the home's value, are far less likely to default. That 20% stake in the game, that skin in the game, makes you a safe bet. But when you put down less than 20%, say 5% or 10%, your loan-to-value ratio, or LTV, is 95% or 90%. From the lender's perspective, you're a higher risk. If the housing market takes a slight dip, you could easily owe more than the house is worth. So, to offset that risk, they force you to buy an insurance policy for them. That's PMI. Let's put some real numbers on this because that's when the pain really sets in. Let's say you're looking at a $400,000 home. A pretty standard price in many parts of the country today. To hit that magic 20% down payment, you'd need to bring a staggering $80,000 in cash to the table, plus closing costs. For most people, that's an insurmountable mountain of money. So, let's say you've managed to save half of that, a very respectable $40,000, which is 10% down. You go to get a conventional loan for the remaining $360,000. Because your loan-to-value is 90%, the lender will slap you with PMI. The cost of PMI varies based on your credit score and loan amount, but a typical rate is around 0.5% to 1% of the loan amount per year. Let's be conservative and say it's 0.6%. So, 0.6% of your $360,000 loan is $2,160 per year. Divide that by 12 months and you are paying an extra $180 every single month. That's $180 that doesn't go towards your principal. It doesn't reduce your loan balance. It doesn't build your equity. It is functionally identical to taking $180 in cash every month and setting it on fire. And it gets worse. You're stuck paying this for years. On a conventional loan, you typically have to wait until your loan balance drops to 80% of the original home value to request its removal. And it's not automatically removed until your loan balance hits 78%. with normal amortization that could take 7, 8, even 10 years depending on your interest rate. Over 8 years, that $180 a month adds up to over $17,000. That's $17,000 of your hard-earned money vanished into thin air, all because you couldn't pull together that initial $80,000. This is the trap. The 20% rule creates a massive barrier to entry for homeownership, and PMI is the toll you have to pay for not being able to clear it. Feels unfair because it is. But what if we could restructure the deal entirely? What if we could give the primary lender exactly what they want, a loan with an 80% loan-to-value without you needing to bring 20% in cash? This is the elegant genius of the October 10th 80 mortgage. The name itself is the blueprint. It's not one loan. It's 2 loans plus your down payment that work together. Let's go back to our $400,000 house. You still have your $40,000 down payment, which is 10%. Here's how the October 10th 80 structure works. First, the 80. You get your primary main mortgage for 80% of the home's purchase price. So, on a $400,000 home, that's a first mortgage of $320,000. Now stop and think about that. From your main lender's perspective, what is the loan-to-value on that mortgage? It's $320,000 on a $400,000 asset. That's exactly 80% LTV. It hits their magic number. And because that primary mortgage is at 80% LTV, it does not require private mortgage insurance. PMI is immediately off the table. But wait, you're thinking that only adds up to $360,000. I need $400,000. Where does the rest of the money come from? That brings us to the first 10. This is the piggyback loan. You take out a second, smaller loan for 10% of the purchase price, which in this case is $40,000. This second loan sits on top of, or piggybacks, on the first mortgage. This is often a home equity line of credit, or HELOC, but it can also be a fixed-rate second mortgage. This loan covers the gap between your first mortgage and your down payment. And finally, the last 10. That's you. That's your $40,000 cash down payment. So let's add it all up. The $320,000 first mortgage, plus the $40,000 second mortgage, plus your $40,000 down payment, equals the $400,000 purchase price. You have successfully bought a home with 10% down, and you have completely sidestepped the PMI requirement. Instead of one monthly payment of principal, interest, and PMI, you now have 2 monthly payments. One for your main 80% mortgage, and a second smaller payment for your 10% piggyback loan. Now, you're probably asking, is the combined payment of those 2 loans actually less than the single loan with PMI? And that is the multi-$1,000 question. In many cases, the answer is a resounding yes. The interest rate on the second loan is almost always higher than the first, but here's the key. The interest you pay on that second mortgage is often tax-deductible, just like your primary mortgage interest. PMI is not. Furthermore, you're paying interest on a much smaller $40,000 loan, instead of paying an insurance premium calculated on a massive $360,000 loan balance. Even if the monthly payments are very close, every dollar you pay on the October 10th, 80 goes toward either interest or principal. You are building equity with every single payment. With PMI, you are just lighting money on fire. This strategy transforms a deadweight loss into a potential financial gain, all while getting you into the house you want years sooner. So let's pull back the curtain on exactly how this financial magic trick works. It's not smoke and mirrors. It's just smart math that the banks themselves created. The name itself, October 10th 80, is the exact recipe. It describes how the purchase of your home is funded. 80%, 10%, and 10%. Let's break it down piece by piece using a real-world example. Imagine a couple, we'll call them Mark and Sarah. They've been saving diligently, they have great credit, stable jobs, and they found a house they love for $500,000. The perfect house. The problem? The dreaded 20% down payment. 20% of $500,000 is $100,000. That's a mountain of cash. After years of saving, they've managed to put together $50,000. They're halfway there. Under the old rules, they have 2 options. 1. Keep renting for another 3 to 5 years, desperately trying to save the other $50,000, while home prices and interest rates likely climb even higher, potentially pricing them out of the market forever. Or 2, they take their $50,000, put 10% down, and get stuck paying private mortgage insurance. On a $450,000 loan, that PMI could easily be $300 to $400 a month. That's over $4,000 a year every year thrown into a black hole. Money that builds them zero equity. It's a penalty for not being rich enough, and it's a terrible feeling. But Mark and Sarah are smart. They've been watching videos like this one. They know there's a third option, the October 10th 80. Here's how it works for their $500,000 house. First, the 80. This is your primary mortgage. Mark and Sarah will get a main loan for 80% of the home's value. In this case, that's $400,000. This loan is your workhorse. It's typically a standard 30-year fixed-rate mortgage. It's predictable, it's stable, and it's the biggest piece of the puzzle. From the bank's perspective, this is a very safe loan because it's only for 80% of the home's value, meaning there's a 20% equity cushion right from the start. Next, we have the first 10. This is the secret ingredient. This is a second, smaller loan for 10% of the home's value. For Mark and Sarah, that's $50,000. This is often called a piggyback loan because it metaphorically rides on the back of the much larger primary mortgage. This second loan is what fills the gap. It's the key that unlocks the door. Finally, we have the second 10. This is Mark and Sarah's contribution. This is their down payment, the $50,000 in cash they worked so hard to save. So let's add it up. You have the 80% main loan, which is $400,000. You have the 10% piggyback loan, which is $50,000. And you have their 10% cash down payment, another $50,000. What does that equal? $500,000. The exact price of the house. But here is the crucial part. Look at it from the perspective of the bank providing that big primary 80% mortgage. When they look at the deal, what do they see? They see their $400,000 loan, and they see a combined down payment of $100,000, $50,000 from the piggyback loan and $50,000 from Mark and Sarah's savings. To them, it looks just like a standard 20% down payment. Their loan-to-value ratio is 80%. And because of that, there is no requirement for private mortgage insurance. The PMI monster is slain before it ever had a chance to breathe. Mark and Sarah get the house, they avoid PMI, and instead of throwing away $4,000 a year, they are now making two separate mortgage payments. One large one for the 80% loan, and one much smaller one for the 10% loan. And here's the beautiful part. Every single dollar of that second payment is going towards interest and principal on a loan. It's building their equity. It's paying down their debt. It's an investment in their own future, not an insurance company's bottom line. Now you're probably thinking, okay, that sounds great, but what's the catch with that second loan? That 10% piggyback? That is the right question to be asking because this is where you need to pay close attention. This second mortgage isn't just a mini version of the first one. It operates differently and comes in a couple of flavors, but the most common one you'll encounter is a HELOC, which stands for Home Equity Line of Credit. Think of a HELOC like a credit card that's secured by your house. The bank gives you a credit limit, in Mark and Sarah's case $50,000, and you can draw from it as you need. For an October 10th 80, you typically draw the entire amount at closing to fund the purchase. But here are the key differences. First, the interest rate on a HELOC is almost always variable. It's tied to a benchmark rate, like the prime rate set by the Federal Reserve. So when the Fed raises interest rates to fight inflation, the rate on your HELOC goes up too. Your monthly payment on that second loan is not fixed. Can and will change over time. This is the primary risk you are taking on. You are trading the certainty of a PMI payment for the uncertainty of a variable rate loan. Second, HELOCs have what's called a draw period, usually the first 10 years. During this time, you are often only required to pay the interest on the loan. For Mark and Sarah's $50,000 HELOC, if the interest rate is, say, 8%, their interest-only payment would be around $333 a month. This can make your initial monthly payments surprisingly low. But, and this is a huge but, you aren't paying down a single penny of the $50,000 principal. You're just treading water. After the 10-year draw period ends, the loan enters the repayment period. At this point, you can no longer draw money from it, and your payment is recalculated to pay off the entire remaining balance, plus interest over the remaining term, which is usually 15 or 20 years. This causes your payment on that second loan to jump up significantly, because now you have to start attacking that principal balance. So let's be crystal clear about the trade-off. With PMI, you have a fixed, predictable expense for a set number of years that gives you zero return. It's a pure loss. With an October 10th 80 using a HELOC, you have a second loan payment that builds equity, but it comes with a variable interest rate and a more complex loan structure. You're swapping a simple, bad option for a more complex, potentially powerful option that carries its own set of risks. The goal for most people using this strategy isn't to carry that second mortgage for 30 years. Not at all. The goal is to get into the house, avoid PMI, and then aggressively pay down that HELOC as fast as humanly possible. Or wait until you have 20% equity in the home through a combination of your payments and the home's appreciation, and then refinance both loans into one single conventional mortgage, getting rid of the HELOC entirely. The October 10th, 80 isn't the final destination. It's the vehicle you use to get to the destination of stable, long-term homeownership. It's a strategic move in a larger financial chess game. You're using the bank's own rules and products to structure a deal that benefits you more than the standard path they lay out for most people. You are taking on calculated, manageable risk to sidestep a guaranteed, unrecoverable loss. But this raises the most important question of all. Is this strategy actually right for you? Because while it can be a financial lifesaver for some, for others, it can be an absolute trap. The answer depends entirely on your financial discipline, your tolerance for risk, and your plans for the future. And that's exactly what we need to break down next. So let's start by painting two very different pictures. Two different homebuyers both looking at the same tool, the October 10th 80 loan. For one, it's a key that unlocks a brighter future. For the other, it's a key that locks them in a financial prison. First, meet Sarah. Sarah is a surgical resident. For the last 5 years, she's been working 80-hour weeks, earning a modest residence salary, and tackling a mountain of student loan debt. But now, she's just accepted a position at a major hospital. Her income is about to triple. She has a stellar credit score, a guaranteed employment contract, and a clear upward financial trajectory. The problem? Her savings are almost non-existent. After years of just getting by and paying down high-interest student loans, she's only managed to scrape together about 10% for a down payment on a home. She lives in a competitive, high-cost-of-living city where home prices are appreciating at a dizzying pace. Every single month she waits to save up the full 20%. The price of the home she wants goes up by thousands of dollars. She's on a treadmill running as fast as she can, but the finish line keeps moving further away. If she waits another 2 years to save, she might be completely priced out of the neighborhood she needs to live in for her new job. Her mortgage broker presents her with two options. Option A, a standard loan with 10% down, which means she'll be stuck paying hundreds of dollars a month in private mortgage insurance, or PMI. That's money that's just gone. It doesn't build equity, it doesn't pay down her principal. It's a fee for being a higher-risk borrower. Option B, the October 10th 80 loan. She takes out a primary mortgage for 80% of the home's value. She uses her 10% savings for the down payment, and she gets a second loan, a home equity line of credit or HELOC, for the remaining 10%. For Sarah, this is a strategic masterpiece. By avoiding PMI, she immediately saves over $200 a month. That's $200 she can put directly towards the principal of that second loan. And remember that massive income jump she's about to get? And the annual bonuses that come with her new contract? Sarah's plan isn't to carry this second mortgage for 30 years. Her plan is to attack it. She's going to throw every spare dollar, every bonus check, directly at that 10% HELOC. Her goal is to wipe it out completely in under 3 years. Once that second loan is gone, she owns 90% of her home. And because she bought in an appreciating market, the home's value has likely increased. Within a few short years, she'll have well over 20% equity, allowing her to refinance her primary mortgage into a new single loan, potentially at an even better interest rate. For Sarah, the 80/10/10 wasn't a sign of weakness. It was a calculated short-term bridge. It allowed her to get into the market now, start building wealth through equity now, and stop throwing money away on rent. It was a tool she used with precision, backed by a disciplined plan and a predictable surge in income. It was a lifesaver. Now let's meet David and Megan. They're a wonderful couple with 2 young kids. David works in logistics, and Megan is a part-time administrative assistant. They have good, stable jobs, but their incomes are modest and have been relatively flat for the last few years. They don't get big bonuses, and significant raises are rare. For years, they've dreamed of buying a home in a good school district. They've sacrificed, clipped coupons, and saved every penny. After 5 years of intense effort, they've finally saved up 10% for a down payment on their dream home. But it's a stretch. The house is at the absolute top of their budget. The lender approved them, but the monthly payment will consume a huge portion of their take-home pay. After paying for the down payment and closing costs, Their emergency fund will be dangerously low. When their lender mentions PMI, their hearts sink. It's another few $100s a month that they simply don't have. It makes a tight budget feel impossible. Then the lender offers a solution. The October 10th 80 loan. No PMI. The monthly payment on paper suddenly looks manageable again. Feels like a miracle. They can get their dream home after all. They sign the papers, thrilled and relieved. But they didn't use this tool like a surgeon with a scalpel. They used it like a crutch to limp into a house they couldn't truly afford. Here's where it becomes a trap. They now have 2 mortgage payments every month. And that second loan, the HELOC, has a variable interest rate. For the first year, things are okay. But then the economy shifts. The Federal Reserve starts raising interest rates to combat inflation. And a letter arrives in the mail. The interest rate on their HELOC has adjusted. Their monthly payment for that second loan has just jumped by $100. A few months later, it jumps again. What was once a tight budget is now officially broken. They're cutting back on groceries, canceling the kids' activities, and the stress is becoming immense. Unlike Sarah, they have no extra income to aggressively pay down the HELOC. They're stuck making the minimum payments, with most of that money just going to the ever-increasing interest. They're not building equity. They're just treading water. Then the housing market, which had been red-hot, cools off. Their home's value stagnates. They're trapped. They can't sell because after realtor fees, they'd have to write a check just to get out of the house. They can't refinance because they don't have enough equity. They are shackled to 2 loans, one of which has a payment that can change at any time, completely outside of their control. One day, the water heater breaks. It's a $2,000 repair they can't afford. Their emergency fund is gone. They have to put it on a high-interest credit card, adding yet another monthly payment to their fragile budget. For David and Megan, the October 10th 80 wasn't a bridge. It was a financial tightrope with no safety net, stretched over a canyon of variable interest rates and market uncertainty. It allowed them to buy a house, but it cost them their financial peace of mind. So what was the fundamental difference between Sarah's success and David and Megan's struggle? It wasn't the loan. The loan was identical. The difference was the borrower. Sarah had a clear, predictable, and significant increase in income on the horizon. David and Megan did not. Sarah had a disciplined, aggressive strategy to eliminate the second loan in a very short time frame. David and Megan had only hope. Sarah used the loan to leverage her future earning potential. David and Megan used it to stretch their current maxed-out budget. Sarah was buying a home she would soon be able to easily afford. David and Megan bought a home they could barely afford on day one, leaving no room for error, no buffer for life's inevitable surprises. The October 10th 80 is a form of leverage. And like any leverage, it magnifies outcomes. For a borrower on a solid financial footing with a strong upward trajectory, it can magnify success, accelerating wealth creation. But for a borrower who is already stretched thin, it magnifies risk, accelerating financial distress. It's a financial power tool. In the hands of a skilled professional with a clear blueprint, it can build something amazing. In the hands of someone without a plan or the resources to handle it, it can cause devastating damage. Understanding which category you fall into is the most important first step. But it's not the only step. Because even if you are a Sarah, there are still critical details hidden in the fine print of that second loan, the HELOC, that can turn a great strategy into a nightmare. What are the terms? What is the draw period versus the repayment period? What index is the variable rate tied to? And what are the caps on how high it can go? These aren't just minor details. They are the gears of the machine. And knowing exactly how they work is the difference between being in control of your financial future and giving that control away to the bank. And that is precisely what we need to expose next. Let's expose the single most misunderstood and frankly the most dangerous part of the entire October 10th 80 structure, that second loan. That little tin that seems so harmless. Most homebuyers, and even a shocking number of loan officers, treat it like a miniature version of the first mortgage. It is not. It is a completely different financial instrument, with its own set of rules, its own risks, and its own traps. This is where the banks hide their leverage. This is where uninformed buyers get burned. Think of your 80% primary mortgage as the main engine of a massive ship. It's powerful, it's predictable, it's built for the long haul. You know the interest rate, you know the payment, and it will be the exact same number on month 1 as it is on month 360. It's stable. That second loan, the 10%, is like a secondary experimental engine bolted to the side. It might be smaller, but it's often far more volatile. and its performance can change dramatically based on economic, whether you have absolutely no control over. Ignoring how this second engine works is like setting sail into a storm without checking the forecast. So what is this thing really? Typically, that second 10 loan will take one of two forms: a home equity line of credit, known as a HELOC, or a fixed-rate second mortgage. Let's start with the more common, and potentially more treacherous one, the HELOC. A HELOC is not a standard loan where you get a lump sum of cash up front. It's a revolving line of credit like a credit card that's secured by your house. For the October 10th, 80, the bank gives you the full amount you need for the down payment, but the loan itself is structured as a credit line. And here is the first critical detail. HELOCs are almost always variable rate loans. Your interest rate is not locked in. It floats. It's typically tied to a benchmark called the prime rate, which is the rate banks charge their most creditworthy customers. And the prime rate moves in lockstep with the federal funds rate, which is set by the Federal Reserve. Do you see the chain of command here? A group of people in a boardroom in Washington, D.C. can make a decision to fight inflation, and the very next month your house payment goes up. It's a direct line. So when you sign up for that HELOC, you are essentially making a bet on the future of the U.S. economy. In a period of low, stable interest rates, this might seem fine. But we've all just lived through a period of rapid rate hikes. Imagine you bought a $500,000 home with an October 10th 80. Your second mortgage is $50,000. Maybe you got a great introductory HELOC rate of 5%. Your interest payment is about $208 a month. Manageable. But then, over the next 18 months, the prime rate shoots up by 4 percentage points. Suddenly, your HELOC rate is 9%. Your payment just jumped to $375 a month. That's an 80% increase on that part of your payment. It's a ticking time bomb tied to macroeconomic forces you cannot influence. But the variable rate isn't even the most deceptive part of the HELOC. The real trap is something called the draw period. Most HELOCs are structured with an initial period, usually 10 years, where you are only required to pay the interest. You are not required to pay a single penny towards the principal balance of $50,000. You're just servicing the debt. This is why the initial payments can seem so deceptively low. You're making a $200 or $300 payment every month for 10 straight years, and at the end of that decade you still owe the full $50,000. You've paid the bank over $25,000 in interest and have made zero progress. You've been running on a financial treadmill, sweating every month, but ending up in the exact same spot you started. And that's when the second, more brutal phase kicks in: the repayment period. After 10 years of interest-only payments, the loan is re-amortized. This means the bank says, "Okay, time's up. Now you have to pay back that entire $50,000 principal plus interest over the remaining term," which is typically 15 or 20 years. Your payment doesn't just go up, it explodes. That $50,000 balance that was costing you a few hundred a month in interest now has to be paid off on an accelerated schedule. Your monthly payment can easily double or triple overnight. It's a payment shock that has forced countless families into foreclosure, all because they didn't understand the two-stage structure of the loan they signed up for a decade earlier. Now, what about the alternative? The fixed-rate second mortgage. This sounds much safer, right? And in some ways it is. The rate is fixed, the payment is predictable, and you're paying both principal and interest from day one. There are no surprises. You know exactly what you'll owe every month for the life of the loan, which might be 15 or 20 years. So what's the catch? The catch is the rate itself. The interest rate on a fixed-rate second mortgage will almost always be significantly higher than the rate on your primary, 80% mortgage. If your primary mortgage is at 6.5%, don't be surprised to see the fixed-rate second quoted at 9, 10, or even 12%. Why? Because of risk. It all comes down to something called lien position. In the event of a foreclosure, when the house is sold, the lender in the first lien position, your primary mortgage lender, gets paid back first from the proceeds. The lender for the second mortgage is in the second lien position. They only get paid if there's money left over after the first lender is made whole. In a down market, they could easily get nothing. To compensate for this massive risk, they charge a much higher interest rate. So while you get stability, you pay for it through the nose over the life of the loan. You're trading the risk of a variable rate for the certainty of a high one. And there's one final hidden snare to look for, more common with these fixed-rate seconds: the prepayment penalty. You might think, I'll just work hard for a few years, save up, and pay this expensive second mortgage off early. Not so fast. Some of these loans have a clause that states if you pay the loan off within the first 2, 3, or even 5 years, you owe the bank a penalty fee. This fee is often calculated as a percentage of the loan balance or a certain number of months' worth of interest. Why would they do this? Because they calculated their profit based on you paying that high interest rate for a set number of years. By paying it off early, you're cutting into their projected earnings, so they penalize you to get their money back. It's a mechanism designed to keep you trapped in their high-interest debt, punishing you for being financially responsible. So this is the reality of that 10 in the October 10th 80. It's not just a smaller loan. It's a choice between a variable rate loan with an interest-only period and a massive payment shock baked into its future, or a stable, fixed-rate loan that charges a punishingly high interest rate and might even penalize you for trying to pay it off. These aren't minor details. This is the fine print where financial futures are made or broken. We've just navigated the minefield and identified the traps. So the unavoidable question is, given these dangers, is there any safe path through? Is the 80/10/10 ever a smart move, or should we avoid it entirely? The answer is yes, it can be a brilliant strategy, but only if you know exactly what you're doing. And that requires knowing the 3 critical questions you must ask your lender before you ever agree to take on a second mortgage. Those questions are what we're breaking down next. Alright, the first question you need to ask isn't just a question. It's a test. It's a simple, direct query that immediately tells you whether the lender sees you as a partner or as a profit center. You look them straight in the eye, whether it's in person or over the phone, and you ask, is there a prepayment penalty on this second mortgage? Their answer, and more importantly, their reaction to that answer, will tell you everything. A prepayment penalty is exactly what it sounds like. It's a fee the lender charges you if you pay off the loan too early. Think of it like an early termination fee on a cell phone contract, but instead of a couple $100, it could be thousands or even tens of thousands of dollars. It's a financial handcuff designed to keep you trapped in their loan, paying them interest for a set period of time, usually the first 2 to 5 years. Now, why is this the ultimate litmus test? Because a predatory lender loves prepayment penalties. They'll try to downplay it. They'll say something like, oh, that's just a standard clause to cover our administrative costs. Or, don't worry, you're not planning on moving in the next 3 years anyway, right? Wrong. That's a massive red flag. Life happens. You might get a huge promotion and want to pay off that second mortgage to free up cash flow. You might need to relocate for a family emergency. Or more likely, interest rates might drop significantly in a year or two, and you'll want to refinance both your first and second mortgages into one new, lower-rate loan. A prepayment penalty slams that door in your face. It forces you to either stay in a loan that's no longer good for you, or pay a king's ransom to escape. A good, reputable lender, on the other hand, will likely give you a clear and simple no. They might even explain why they don't use them, saying something like, we don't believe in penalizing our clients for being financially responsible. If you're in a position to pay off your loan early, we celebrate that with you. That's the kind of partner you want. So, question number 1 isn't just about a fee. It's about revealing the lender's entire philosophy. It separates the trappers from the true advisors. Once you've cleared that hurdle, you move on to the second critical question, which is designed to protect you from a ticking time bomb. You ask, is this loan fully amortizing, or does it have a balloon payment? Now that term balloon payment should send a shiver down your spine. Let me explain what it is. A balloon mortgage is a loan where you make smaller, often interest-only, payments for a set period, say 5, 7, or 10 years. Feels great at first. Your monthly payment is deceptively low. But here's the catch. At the end of that term, the entire remaining loan balance becomes due. All at once. In one massive balloon payment. We're not talking about a final house payment. We're talking about a payment that could be 80, 90, or even 100% of the original amount you borrowed. Imagine you took out a $50,000 second mortgage. You pay a few $100 a month for 10 years, feeling like you're on top of the world. Then, on the first day of year 11, you get a bill from your lender for $50,000 due in 30 days. What do? Most people don't have that kind of cash just lying around. So, your only options are to sell the house or try to refinance the debt. But what if the housing market has crashed? What if your credit score has dropped? What if interest rates have skyrocketed? You could be trapped, facing foreclosure, all because of that hidden time bomb you didn't know was ticking. A shady lender won't always use the word balloon. They'll use confusing jargon. They might call it a loan with a final settlement payment, or one that matures before it's fully paid. That's why you have to be direct. Is this loan fully amortizing? A fully amortizing loan is the gold standard. It means that every single payment you make consists of both principal and interest, and it's calculated precisely so that when you make your very last scheduled payment, your loan balance hits zero. No surprises, no giant check to write at the end. It's predictable, it's safe, and it's the only structure you should accept for your second mortgage. If the lender hesitates or tries to sell you on the low payments of a balloon-style loan, you thank them for their time, you hang up the phone, and you run. Okay, so you've dodged the prepayment penalty and you've defused the balloon payment bomb. You're in the clear, right? Not yet. The third question is arguably the most complex because it deals with the very engine of the loan, the part that determines how much this debt will actually cost you over its lifetime. You need to ask with absolute clarity, is the interest rate on this second mortgage fixed or variable? And what is the exact term of the loan? This is really a two-part question, and both parts are equally important. Let's start with fixed or variable. A fixed-rate loan is simple. The interest rate is locked in on day one and it never ever changes. If you get a 15-year fixed rate at 8%, your payment will be the exact same for all 180 months. It's the definition of stability. A variable rate or an adjustable rate mortgage arm is the opposite. It's a chameleon. It starts with a low, attractive teaser rate for an initial period. But after that, the rate can change, it can adjust up or down based on a specific financial index like the prime rate. The problem is, in a rising rate environment, it almost always adjusts up. Your lender might pitch you on a variable rate HELOC, a home equity line of credit, for your second mortgage, highlighting the super low initial payment. They'll be vague about how high it could go, saying things like, "Oh, it just moves with the market." But here's the reality. These loans have rate caps, but they can be shockingly high. Your 5% introductory rate could jump to 7%, then 10%, then 12% or higher over the years. A monthly payment that was a manageable $500 could suddenly become $800 or even $1,000, wrecking your budget and putting you under immense financial stress. Unless you have a very specific short-term strategy and a high tolerance for risk, you should almost always insist on a fixed interest rate for your second mortgage. You want predictability above all else. The second part of the question is, what is the exact term of the loan? This is crucial. The term is simply the length of time you have to pay it back. For these piggyback loans, you'll typically see terms of 10, 15, or even 20 years. A shorter term like 10 years means a higher monthly payment, but you'll pay far less in total interest and be debt-free much faster. A longer term like 20 years will have a lower monthly payment, making it seem more affordable, but you'll end up paying thousands or even tens of thousands more in interest over the life of the loan. There is no single right answer here. It depends on your personal financial goals. Do you want to minimize your monthly payment? Or do you want to minimize your total long-term cost? The important thing is that you know the exact terms so you can make an informed decision. A good lender will lay out the options for you. A 10-year, a 15-year, and a 20-year. And show you the difference in both the monthly payment and the total interest paid for each. A predatory lender will often just push the longest possible term to make the payment look as small as possible, hoping you don't do the math on the staggering long-term cost. These three questions about prepayment penalties, balloon payments, and the rate and term structure are your shield and your sword. They protect you from predatory practices and empower you to cut through the noise and confusion. Answering them correctly is the bare minimum requirement for any lender you consider working with. But knowing you have a safe loan isn't the same as knowing you have a smart loan. Now that you know how to vet the lender and the loan structure, we have to answer the ultimate question. Does the October 10th 80 strategy actually save you money? Is it truly better than just getting a 90% loan-to-value mortgage and paying the PMI? To figure that out, we need to put them head-to-head in a bare-knuckle brawl of numbers. We're going to run a side-by-side cost analysis, breaking down every dollar to see which strategy comes out on top. Alright, let's set the stage for this financial showdown. We need a scenario, a real-world example that we can tear apart and analyze. Let's imagine a couple, we'll call them Alex and Jamie. They've been saving diligently, they've got good credit, say a 740 FICO score, and they've found their dream home. The price tag? A cool $500,000. It's a stretch, but they believe they can make it work. They've managed to save up $50,000 for a down payment. That's exactly 10%. Not the 20% everyone tells you is mandatory, but a very respectable amount. Now, they're at a crossroads facing the two paths we've been talking about. Path number one is the traditional route. They put their 10% down and get a single 90% loan-to-value mortgage. Path number two is the October 10th 80 piggyback loan. Let's break down the costs of each dollar for dollar and see who comes out ahead. First up, the traditional loan with private mortgage insurance or PMI. The house is $500,000. Their down payment is $50,000. So, their total loan amount is $450,000. For our example, let's assume they lock in a 30-year fixed interest rate of 6.5%. Based on that, their monthly principal and interest payment comes out to be about $2,844. But that's not their total payment. Because they didn't put 20% down, the lender sees them as a higher risk. To protect themselves, the lender slaps on PMI. The cost of PMI varies based on your credit score and loan amount, but a reasonable estimate for a 740 score is around 0.75% of the loan amount per year. So, we take our $450,000 loan, multiply it by 0.0075, and we get $3,375 per year. Divide that by 12 months, and you get a PMI payment of $281.25. Every single month. That's nearly $300 that isn't paying down their loan, it isn't building equity, it's just gone. It's pure insurance cost. Of course, we also have to factor in property taxes and homeowners insurance, often called PITI. Let's estimate property taxes at 1.25% of the home's value annually, and homeowners insurance at $150 a month. That adds another $671 to their monthly nut. So, let's add it all up for the PMI strategy. We have $2,844 in principal and interest, plus that painful $281 for PMI, plus $671 for taxes and insurance. Their grand total monthly payment is $3,796. Remember that number, $3,796. Now let's rewind time and have Alex and Jamie choose path number 2. The October 10th 80 piggyback loan. The purchase price is the same $500,000. Their down payment is the same $50,000. But how they finance the rest is completely different. Instead of one giant loan, they get two. The first mortgage is for 80% of the home's value. 80% of $500,000 is $400,000. Because this loan is at that magic 80% loan-to-value ratio, the lender is happy. They don't require PMI. Let's assume they get the same great 6.5% interest rate on this loan. The monthly principal and interest payment on a $400,000 loan at 6.5% over 30 years is $2,528. Now for the second piece of the puzzle, that other 10%. They take out a second loan, typically a home equity line of credit or HELOC, for the remaining $50,000. These second position loans are riskier for the lender, so they carry a higher interest rate. Let's say the rate on their HELOC is 8.5%. Here's a critical detail about HELOCs. During the initial draw period, which can last up to 10 years, they are often interest-only. So, Alex and Jamie are only required to pay the interest on that $50,000. The interest-only payment on $50,000 at 8.5% is about $354 per month. So let's assemble the October 10th 80 payment. The first mortgage is $2,528. The second mortgage is $354. And the private mortgage insurance? $0. It's completely gone. The taxes and homeowners insurance are the same, of course, at $671. Add it all up. $2,528 plus $354 plus $671. Their grand total monthly payment is $3,553. Now for the moment of truth. Let's put those two numbers side by side. The traditional loan with PMI had a monthly payment of $3,796. The October 10th 80 strategy has a monthly payment of $3,553. That is a difference of $243 per month. Let that sink in. By restructuring their financing, Alex and Jamie are saving $243 every single month. That's nearly $3,000 a year. That's a vacation. That's a significant extra payment towards their student loans. That's a huge boost to their retirement savings. In the early rounds of this fight, the October 10th 80 strategy scores a massive, undeniable knockout. Puts real money back in your pocket from day one. But, and you knew there was a but coming, this isn't the whole story. A lower monthly payment is fantastic, but it's not the only factor. We've only looked at the surface level numbers. To truly declare a winner, we need to dig deeper into the hidden risks and secret advantages of each strategy. Let's start with the biggest risk of the October 10th 80, that second loan. That HELOC with the 8.5% rate? It's almost always a variable rate. This means it's tied to a benchmark, like the prime rate, which moves when the Federal Reserve adjusts interest rates. If the economy heats up and the Fed raises rates, that 8.5% could become 9.5% or 10.5% or even higher. Their $354 monthly payment isn't set in stone, can and likely will change. This introduces an element of uncertainty that the fixed-rate PMI loan simply doesn't have. You're trading a guaranteed cost, PMI, for a potentially volatile one, HELOC interest. And there's another catch with that HELOC. Remember how I said the initial payments are often interest only? Well, that initial draw period eventually ends. After, say, 10 years, the loan enters the repayment period. At that point, Alex and Jamie can no longer just pay the interest. They have to start paying back the $50,000 principal, usually over the remaining 15 or 20 years of the loan term. This will cause their HELOC payment to jump significantly, a phenomenon known as payment shock. They go from paying $354 a month to potentially over $500 or $600 a month, depending on the interest rate at that time. You have to be prepared for that. So the October 10th 80 isn't a free lunch. It demands a more financially savvy and prepared homeowner. But then the 80/10/10 has a secret weapon, a trump card that PMI can't match: tax deductibility. As of the current tax laws, the interest you pay on mortgage debt, up to a certain limit, is tax deductible. With the October 10th 80, the interest from both the first $400,000 loan and the second $50,000 loan is potentially deductible. This means it reduces your taxable income, which can lead to a lower tax bill or a bigger refund at the end of the year. Now compare that to PMI. That $281 you're paying every month? It's a ghost. It offers zero tax benefits. The tax deduction for PMI expired and has not been renewed. So, the government is essentially giving you a discount on the interest for the October 10th 80 loans, while offering you absolutely nothing for your PMI payments. This tax advantage can further widen the financial gap between the two strategies, making the real, after-tax savings of the October 10th 80 even greater than that initial $243 per month. So what have we learned? The October 10th 80 offers a lower initial monthly payment and a powerful tax advantage. The PMI route offers simplicity and the stability of a single, predictable payment. One gives you immediate cash flow but introduces long-term risk and complexity. The other is more expensive upfront but is straightforward and stable. This isn't just a math problem anymore. It's a question of financial philosophy. Do you prioritize immediate savings, and are you comfortable managing variable rates and future payment changes? Or do you prioritize predictability and simplicity, even if it costs you more each month? The right answer depends entirely on you. So let's break down who benefits most from each approach, using real-world profiles. We'll move beyond the abstract numbers and look at the types of people and situations where the October 10th 80 isn't just a good idea, it's a strategic masterpiece. First, let's talk about the high-income, high-credit score professional. Think doctor, lawyer, tech executive. For this buyer, the October 10th 80 can be a powerful tool for a few key reasons. Often, they're looking at homes that push the limits of conforming loan amounts, tipping them into jumbo loan territory. Jumbo loans typically have stricter down payment requirements, often demanding a full 20% down. But by using an October 10th 80, this buyer can structure the deal to keep the first mortgage under the jumbo loan limit, which often means a better interest rate and more lenient underwriting guidelines on that primary loan. The second 10% loan might be at a higher rate, but it's a smaller, manageable amount. More importantly, for a high-income earner, the interest on both the first and second mortgages is typically tax-deductible, up to the federal limits. PMI, on the other hand, is not. The tax savings alone can make the October 10th 80 a significantly cheaper option on an after-tax basis. This buyer also likely has the cash flow to aggressively pay down that second mortgage. They can treat it like a car payment on steroids, aiming to obliterate it in 2 to 5 years, freeing up hundreds of dollars in their monthly budget long before PMI would have naturally fallen off. Next up, a profile that doesn't get talked about enough: the self-employed entrepreneur or the commission salesperson. Anyone with what we call variable or lumpy income. For these individuals, getting a mortgage can already be a paperwork nightmare. Lenders scrutinize their income with a fine-toothed comb. When you add PMI into that mix, it gets even more complicated. PMI companies are essentially insurance providers, and they are notoriously risk-averse. They might see that variable income and slap on a higher PMI premium, or they might influence the primary lender to be even more strict. The October 10th 80 strategy neatly sidesteps this. By splitting the financing into two separate loans from two, or sometimes even the same lender, you compartmentalize the risk. The first 80% loan is a standard, low-risk mortgage. The second 10% loan, often from a local bank or credit union that understands the local economy, is viewed as a separate, smaller transaction. That lender might be more comfortable with a local business owner's income profile than a large, national PMI corporation would be. It creates a path to approval and avoids the penalty box of high-cost PMI that often punishes those who don't have a simple W-2 pay stub. Now let's shift gears and look at the market itself. Consider the buyer in a rapidly appreciating real estate market. This is where the debate between an October 10th, 80 and PMI becomes a fascinating race against time. With PMI, your path to getting rid of it, besides paying down the loan to 78% loan-to-value, is through appreciation. Let's say you buy a house for $500,000 with 10% down. You have a $450,000 loan. If, after 2 years, the market has gone crazy and your home is now appraised at $625,000, your $450,000 loan is now only 72% of the home's new value. You can then petition your lender, pay for a new appraisal, and potentially have the PMI removed. That's a great outcome, but it's not guaranteed. You're at the mercy of the market and the appraiser. The October 10th 80 offers a different kind of control. You have a second mortgage payment, yes, but you are in the driver's seat for eliminating it. You don't need the market to boom. You don't need an appraiser's approval. You just need to write checks. Every extra dollar you throw at that second mortgage directly reduces the principal and gets you closer to freedom. For the disciplined saver who wants a clear, predictable path to lowering their housing costs, the October 10th 80 provides a target you can hit through your own efforts, regardless of what the broader economy is doing. If the market goes up, great, you've built equity. If the market stays flat, it doesn't matter. You can still execute your plan and pay off that second loan. This is about control versus speculation. And that brings us to our fourth profile: the aspiring real estate investor. The person who sees their primary home not just as a place to live, but as the first step in building a property portfolio. For this person, an October 10th 80, specifically one where the second loan is a home equity line of credit or HELOC, is an absolute secret weapon. Here's why. You buy your home with an October 10th 80 HELOC. For the first few years, you live in the house and aggressively pay down the balance on that HELOC. Let's say you pay it all the way down to zero. Now you don't just have zero payment. You have an open, ready-to-use line of credit for 10% of your home's original purchase price, sitting there waiting. When a great investment opportunity comes up, a fixer-upper, a rental property down the street, you don't need to scramble for a down payment. You can simply draw from your HELOC. You've essentially used the purchase of your own home to create the seed capital for your first investment property. This transforms a simple mortgage into a dynamic financial tool. Trying to do this with a PMI loan is much clunkier. You'd have to wait for equity to build, then apply for a brand new cash-out refinance or a separate HELOC, going through the entire underwriting process all over again. The October 10th 80 HELOC front-loads that opportunity, giving you a massive strategic advantage. But to be perfectly balanced, let's be clear. The October 10th 80 is not for everyone. When is traditional PMI the undisputed champion? Consider the buyer who has an absolutely stellar 800+ credit score and a stable W-2 job. Lenders and PMI companies love this profile. They will compete for this person's business, often offering incredibly low PMI rates. In some cases, the monthly PMI payment could be significantly lower than the payment on a 10% second mortgage, especially in a higher interest rate environment. This person might also value simplicity above all else. They want one loan, one payment, one statement. They don't want to manage a variable rate HELOC or think about two separate due dates. For them, the set-it-and-forget-it nature of a single loan with PMI is worth the cost. The path to removal is passive, it just happens over time as they make their regular payments. There's no complex strategy, just a simple, predictable monthly obligation. If the numbers work out and simplicity is your highest priority, PMI can absolutely be the right call. It's the straightforward vanilla option, and sometimes that's exactly what a homebuyer needs. It all comes down to a clear-eyed assessment of your finances, your temperament, and your long-term goals. So when we talk about goals, let's be honest. For most of us, the ultimate goal isn't just owning a house. It's achieving a level of financial freedom where the house serves you, not the other way around. And this is where the October 10th, 80 loan shifts from being a simple home buying tool into a full-blown financial strategy. Because unlike a standard loan with PMI, the October 10th, 80 doesn't just end when you sign the closing papers. In fact, that's when the real game begins. You've successfully used a clever maneuver to get into the home, avoiding PMI. Congratulations! Now you have a new mission, and it should become your absolute obsession. Assassinating that second mortgage. That 10% loan, whether it's a fixed-rate second or more commonly, a home equity line of credit or HELOC, is not your friend. It's a temporary ally of convenience that needs to be dealt with swiftly and ruthlessly. Why the urgency? Because that second loan is often the riskiest part of the entire equation. If it's a HELOC, it almost certainly has a variable interest rate. That means as the Federal Reserve adjusts rates to manage the economy, your monthly payment on that loan can fluctuate. Could go up significantly. While your primary 80% mortgage is a predictable, stable pillar of your budget, the HELOC is a wild card. It might also have an interest-only introductory period. This sounds great at first. Your payments are super low, but it's a trap. During that time, you're not paying down a single penny of the principal. You're just treading water. And when that interest-only period ends, typically after 5 or 10 years, you face a payment shock. Suddenly, your payment skyrockets because now you have to start paying back the principal over a much shorter remaining term. This is the hidden danger that turns the dream of an 80/10/10 into a nightmare for the undisciplined. So you need a battle plan. Your HELOC is now public enemy number one in your financial life. Every extra dollar you can find should be aimed directly at its heart. Forget paying extra on your primary mortgage for now. Its interest rate is almost certainly lower, and it's a much larger loan. You attack the smaller, higher interest, more volatile debt first. This is the core principle of the debt avalanche method, and it is perfectly designed for this scenario. So how do you execute this? First, you automate. Set up an automatic extra payment to that second mortgage every single month. Even an extra $50 or $100 a month makes a staggering difference. That small amount goes entirely to principal, which reduces the amount of interest you're charged the following month, creating a snowball effect of its own. Second, you become a windfall warrior. That annual bonus from work? It doesn't go to a vacation. It goes to the HELOC. That tax refund you got from the IRS? Straight to the HELOC. Did you sell some old furniture or get a side hustle going? Every penny goes to the HELOC. You have to be relentless. Think of it like a video game. You're trying to defeat a boss, and every lump sum payment is a massive power-up that drains its health bar. Let's run a quick, hypothetical scenario. Say you have a $50,000 HELOC at a 7% interest rate. If you just make the minimum payments, you'll be paying on that thing for a very, very long time, racking up thousands upon thousands in interest. But let's say you commit to paying an extra $200 every month. You would pay off that loan years earlier and save over $10,000 in interest payments. Now imagine you also get a $5,000 bonus one year and throw it all at the loan. You've just supercharged the process, saving even more time and money. This aggressive paydown strategy is the secret to winning with an October 10th 80 loan. You use it to get in the door, then you work like crazy to eliminate the riskiest part of it as quickly as humanly possible. But that's only phase 1 of the master plan. Phase 2 is the endgame. Refinancing. The ultimate goal for most people who use an October 10th 80 strategy is to eventually combine both loans, the 80% first mortgage and the remaining balance of the 10% second mortgage, into a single new conventional loan. And here's the beautiful part. If you've done it right, you'll do this without ever paying a cent of PMI. The trigger for this move is equity. As you pay down your mortgages and as your home hopefully appreciates in value, you build equity. The magic number you're aiming for is 20%. Once your combined loan-to-value ratio is at 80% or lower, meaning you own at least 20% of your home's value outright, you can typically refinance into a single loan with no PMI. This is where your aggressive paydown of the HELOC really pays off. Not only did you save on interest, but you also accelerated the timeline to reach that 20% equity milestone. Let's walk through a story. Meet Mark and Jessica. They bought a home for $500,000. They had $50,000 for a down payment, exactly 10%. They used an October 10th 80 strategy, so they have a $400,000 first mortgage and a $50,000 HELOC. From day one, they treated that HELOC like it was on fire. They lived frugally for 2 years, throwing every spare cent at it. They managed to pay it down from $50,000 to $25,000. During those same 2 years, the housing market was good to them. and their home's value appreciated to $550,000. Let's do the math. Their total remaining debt is the first mortgage. Let's say they paid it down to $390,000, plus the HELOC, $25,000. That's a total of $415,000. Their home is now worth $550,000. To find their loan-to-value ratio, you divide the loan amount by the home's value. $415,000 divided by $550,000 is 0.75, or 75%. They blew past the 80% LTV mark. They now have 25% equity in their home. At this point, they call a lender. Interest rates are favorable. They refinance both loans into a single new mortgage for $415,000. Their HELOC is gone. The variable rate risk is gone. They now have one simple, predictable monthly payment, and they never once paid for private mortgage insurance. They executed the October 10th 80 strategy to perfection. They used a sophisticated tool not just to buy a house, but to strategically manage their debt and accelerate their path to building wealth. That is the blueprint. That is how this is supposed to work. It's an active strategy, not a passive one. It requires discipline, a clear plan, and a commitment to attacking that second mortgage from the moment you get the keys to your new home. It's about understanding that the 80/10/10 isn't a finish line. It's the starting gun for the next phase of your financial journey. You're not just a homeowner. You're a debt strategist, actively managing your liabilities to maximize your equity. But this strategy isn't a silver bullet. It's a specialized tool, and like any powerful tool, in the wrong hands or used in the wrong situation, it can be incredibly dangerous. There are specific financial profiles and certain market conditions where an 80/10/10 can go from being a brilliant move to a devastating financial landmine. And we're going to walk through exactly who should steer clear of this loan next. First up, let's talk about the house poor hopeful. This is the buyer who has stretched every last dollar to make the 10% down payment. They've scraped together their savings, maybe gotten a gift from family, and on paper they just barely qualify. The loan officer says yes. The numbers technically work. But here's the terrifying reality. They are living on a financial knife's edge. An October 10th 80 loan gives this person two separate mortgage payments. The primary mortgage and the second, the home equity line of credit. For someone with zero financial cushion, this is a recipe for disaster. What happens the first time the water heater breaks? It's not a matter of if, but when. A $3,000 repair bill that a stable homeowner would grumble about becomes a potential foreclosure notice for the house poor hopeful. They can't just put it on a credit card because their debt-to-income ratio is already maxed out from qualifying for two loans in the first place. They have no emergency fund because every penny went into the down payment and closing costs. Suddenly, they're forced to choose between fixing the plumbing and making their second mortgage payment. The very tool they used to get into the house, the 10% second loan, becomes the anchor that pulls them under. This strategy is designed for people with financial flexibility, not for those holding on by a thread. If your budget has no room for error, no room for a surprise $500 expense, let alone a $5,000 one, the dual payment structure of an October 10th 80 is not a clever hack. It's a trap waiting to be sprung. Next, we have the freelancer with fluctuating fortunes. This could be a gig economy worker, a commission-based salesperson, a small business owner, anyone whose income isn't a steady, predictable paycheck every 2 weeks. For these individuals, cash flow is king, but it's also a wild, unpredictable beast. One quarter, you might land a massive project and feel like you're on top of the world. The next, you could be chasing invoices and living off savings. The October 10th 80 loan is fundamentally hostile to this kind of income volatility. Why? Because it demands two consistent, non-negotiable payments every single month. During a slow month, a single, lower mortgage payment from a traditional loan might be manageable. But having to cover both the primary mortgage and the HELOC payment can be brutal. The pressure is immense. And here's the even more insidious danger for this profile: the HELOC itself. The second loan is often a line of credit, which means there's a temptation during lean months to draw from it to cover business expenses, or even just daily living costs. People think, I'll just borrow from the HELOC to make it through this downturn and pay it back when I land the next big client. But what they're actually doing is digging their debt hole deeper. They're borrowing against their home to pay for their life, all while the interest on that HELOC, which is almost always a variable rate, is ticking upwards. It creates a vicious cycle where a temporary income dip turns into a long-term debt problem secured by their own home. For anyone with an unpredictable income, The simplicity and stability of a single fixed-rate mortgage is almost always the safer, smarter long-term play. Then there's the short-term strategist. This is the person who says, I'm only going to be in this city for 3, maybe 4 years for a job, then I'm moving. They see the October 10th 80 as a great way to get into a home with minimal cash down, thinking they'll sell in a few years and walk away with a nice profit. This is one of the most common and catastrophic miscalculations you can make with this loan structure. The entire benefit of an October 10th 80 is predicated on long-term ownership. You need time. Time for the property to appreciate. Time to pay down the principal on 2 loans. Time for your financial investment to actually mature. When you're on a short timeline, everything works against you. First, you're paying closing costs on 2 separate loans, which immediately eats into your potential profit margin. Second, in just 3 or 4 years, you won't have paid down a significant amount of the principal. Most of your payments will have gone towards interest. Third, and most critically, you are completely at the mercy of the market. If the real estate market is flat or, even worse, dips by just a few percentage points during your short ownership window, you could find yourself underwater. This means you owe more on your 2 loans combined than the house is worth. So when it's time to sell, not only will you not make a profit, you will actually have to bring a massive check to the closing table just to get out of the deal. You'll be paying thousands of dollars for the privilege of selling your own home. The October 10th 80 is a tool for building long-term equity, not for short-term housing speculation. If you know you're not staying put for at least 5 to 7 years, this loan structure is simply too risky. We also have to talk about the financially anxious. This isn't about numbers on a spreadsheet. It's about psychology and your personal tolerance for risk. The October 10th 80 loan introduces a major element of uncertainty that can be a source of constant, low-grade stress for many people. The variable interest rate on the second loan. While the primary 80% mortgage is usually a fixed rate, that 10% HELOC is almost always tied to the prime rate. This means that when the Federal Reserve raises interest rates to combat inflation, your monthly payment on that second loan goes up. It might not be a huge jump at first, but it's the unpredictability that gets to people. You lose the peace of mind that comes with a traditional 30-year fixed mortgage, where you know your principal and interest payment will be the exact same number for the next 360 months. With an 80/10/10, you might find yourself watching financial news with a sense of dread, wondering if the Fed's next announcement is going to make your housing costs more expensive. For some people, this financial anxiety is a heavy burden. The mental energy spent worrying about rate hikes and adjusting budgets isn't worth the money saved on PMI. Homeownership should provide a sense of stability and security. If the very structure of your loan undermines that feeling, it's the wrong product for you regardless of what the math says. If you value predictability and a good night's sleep over optimizing every last dollar, you should steer clear and embrace the beautiful simplicity of a single fixed-rate loan. Finally, it's not just about who you are, but where and when you are buying. The October 10th 80 strategy is incredibly sensitive to market conditions. Specifically, it performs best in a steadily appreciating real estate market. The whole game is to use the loan to get into a house and let market appreciation build your equity for you, eventually allowing you to refinance out of the 2 loans and into one better one. But what happens if you use this strategy at the peak of a housing bubble, or in a market that's been stagnant for years? The strategy completely falls apart. In a flat or declining market, you're not gaining that free equity from appreciation. You're just stuck with 90% leverage and 2 monthly payments. Your loan-to-value ratio remains dangerously high. If the market drops 10%, you're instantly underwater. You have 0 equity. You are trapped. You can't sell without taking a huge loss, and you can't refinance because no lender will give you a new loan on a property where you have no stake. This is precisely what crushed so many homeowners in 2008. People who used high-leverage loans found that their escape plan, selling or refinancing, had vanished overnight. The 80/10/10 isn't a magic wand that works in any economy. It's a high-leverage tool that requires the tailwind of a healthy, appreciating market to work effectively. If you're in a city with a shaky job market, declining population, or if national indicators suggest the housing market is cooling off, using an 80/10/10 is like sailing into a hurricane with extra sails. It amplifies your risk exponentially. So we've laid out the danger zones: the buyer with no buffer, the earner with an unstable income, the short-term owner, the risk-averse personality, and anyone buying in a questionable market. These are the critical red flags, the scenarios where this clever-sounding strategy can backfire with devastating consequences. But this doesn't mean the 80/10/10 is inherently bad. For the right person in the right situation, it remains one of the most powerful tools available for building wealth through real estate. The key is knowing with absolute certainty which side of that line you fall on. So what does that ideal candidate look like? What is the definitive checklist you must satisfy before you can confidently say, yes, this is the right move for me? We're about to build that exact profile. Let's paint a picture of the perfect October 10th, 80 candidate. We'll call them the financial strategist. This isn't just someone who wants a house. It's someone who treats their finances like a well-oiled machine. First and foremost, the strategist has a stellar credit score. We're not talking about good enough. We're talking about a score that makes lenders compete for their business. Think 740 or higher. Why is this so critical? Because you're not applying for one loan. You're applying for two. The lender for that first 80% mortgage needs to see you as an A+ borrower, a prime candidate who poses minimal risk. But just as importantly, the lender for that second 10% loan, the HELOC, is in a riskier position. They get paid back only after the first mortgage is settled in a foreclosure. To compensate for that risk, they are going to be even more scrupulous. A high credit score is the non-negotiable entry ticket to this entire strategy. It tells both lenders you have a long proven history of managing debt responsibly. Without it, the door is likely closed before you even start. Next, the strategist has a stable, predictable, and easily verifiable income. This isn't the freelance artist who has fantastic months followed by famine. This is the salaried employee, the professional with a consistent history of earnings, or the business owner with years of strong documented tax returns. Lenders need to see a clear, uninterrupted path of income that proves you can handle not one, but two mortgage payments, even if the second one fluctuates. This brings us to the all-important debt-to-income ratio, or DTI. The strategist keeps their DTI in check. They don't carry high-interest credit card debt or have massive car payments. Ideally, their total monthly debt payments, including the projected cost of both new mortgages, property taxes, and insurance, will be well under 43% of their gross monthly income. For the best rates and easiest approval, they're likely closer to 36%. They understand that a mortgage approval isn't about what a bank will lend you. It's about what you can comfortably afford. Third, and this is a big one, the strategist has cash reserves. They aren't scraping together every last penny for that 10% down payment. They have that 10% plus the money for closing costs on two separate loans, plus moving expenses, plus a healthy emergency fund of at least 3 to 6 months of living expenses left over. This is the ultimate sign of financial health. It shows the lender that a minor life event, a car repair, a small medical bill, won't derail their ability to make payments. It proves they are not living on the financial edge. Using an October 10th 80 loan because you are cash poor is one of the biggest mistakes you can make. This strategy is for people who have the 20% or are very close to it but choose to deploy their capital more strategically. Finally, the financial strategist has a plan. They're not just thinking about buying the house, they're thinking about owning it. They have a long-term horizon, planning to stay in the home for at least 5 to 7 years, allowing them to ride out market fluctuations and recoup their initial closing costs. More importantly, they have an aggressive plan for the HELOC. They see that second mortgage for what it is, a temporary tool with a variable interest rate. Their goal is to attack that HELOC principal with extra payments from day one, aiming to pay it off in just a few years, long before the variable rate can become a major problem. They've run the numbers. They know their break-even point compared to paying PMI, and they have a clear written budget to execute their plan. Now let's flip the coin. Who is this strategy absolutely wrong for? Let's call this person the hopeful homebuyer. The hopeful homebuyer has a decent but not great credit score, maybe in the high 600s. They've had a few late payments in the past but are doing better now. For them, trying for an October 10th 80 is likely a dead end. They'll face rejections or be offered terrible interest rates that negate any potential savings from avoiding PMI. A traditional FHA loan or a conventional loan with PMI is a much more realistic and safer path for them. The hopeful homebuyer might have a new job or a fluctuating income. They're optimistic about the future, but they don't have that 2-year track record of stability that lenders crave. Their DTI is already creeping into the high 40s. For them, adding the complexity and risk of a second, variable rate mortgage is like adding gasoline to a fire. The financial stress could become overwhelming. Crucially, the hopeful homebuyer is stretching to make the 10% down payment. After closing, their savings account will be nearly empty. They have no buffer. This is the single most dangerous scenario. The first time the water heater breaks or the car needs a new transmission, they'll be forced to put it on a high-interest credit card, digging their financial hole even deeper. They don't have the safety net that this advanced strategy demands. And finally, the hopeful homebuyer sees the HELOC as a feature, not a bug. They think, great, I'll have access to a line of credit for new furniture, a vacation, or a new car. This mindset is a catastrophic trap. Using the HELOC for consumer spending, especially when it has a variable interest rate, is a surefire way to destroy the equity in your home and put yourself in a perilous financial position. The HELOC in an October 10th, 80 structure should be viewed as a short-term problem to be eliminated, not a piggy bank to be raided. So how do you decide? Comes down to answering 3 honest questions. 1. Are you a financial strategist or a hopeful homebuyer? Look at the profiles we just built. Which one sounds more like you? Be brutally honest with yourself. Your financial future depends on it. 2. What is your plan for the second mortgage? If your answer is anything other than pay it off as quickly as humanly possible, you should pause. Write down the exact amount of extra money you will pay towards it each month. If you can't commit to a number, this isn't the right move. 3. Have you done the math for your specific situation? Don't rely on articles or videos, including this one, to give you the final answer. Get a real quote for a traditional loan with PMI. See what the monthly PMI costs would be. Then get a real quote for an October 10th 80 loan. Look at the interest rate on that second mortgage. Calculate the total monthly payment. Compare them side by side. Calculate how many months it will take for your PMI avoidance savings to overcome the higher closing costs of the October 10th 80. That is your break-even point. Does it align with how long you plan to be in the home? The October 10th 80 mortgage is not a shortcut. It's not a magic trick to buy a house you can't afford. It is a sophisticated financial instrument, a scalpel for a skilled surgeon. In the hands of a disciplined, well-prepared buyer, our financial strategist, it can be a brilliant tool to save thousands of dollars and build equity faster. But in the hands of someone who is unprepared, over-leveraged, or undisciplined, it can cause immense financial damage. Knowledge is the ultimate power in the home buying process. The fact that you've watched this far means you're already ahead of 99% of buyers. You now understand the mechanics, the pros, the cons, the risks, and the ideal candidate profile for a strategy that most people have never even heard of. Your next step isn't to decide yes or no. Your next step is to take this knowledge and have an intelligent, confident conversation with a trusted, independent mortgage broker. Ask them to run the scenarios for you. Look at the official loan estimate documents for each option. Trust the numbers, but also trust your gut. Choose the path that lets you sleep soundly at night, knowing you've made a smart, sustainable decision for your future. Buying a home is the biggest financial decision of your life. Do it with wisdom, do it with confidence, and build a foundation not just of concrete and wood, but of true financial strength.